Hi, this is Linda Hitt. This is the final video clip on property, plant, and equipment. Here we're going to take a look at actually getting rid of the asset and how we do the accounting for it. The good news is that there's not going to be too many entries to take a look at. We do want to be careful that we have depreciated up until the time that we dispose of the asset. So if we dispose in the end of the month, we got to depreciate for that month. In the process of getting rid of the asset, we're going to make sure we get rid of the main account as well as the contra account. So if we get rid of equipment, we also have to get rid of accumulated depreciation on that equipment. In the process, chances are high that your book value isn't going to exactly equal what you sell it for. So we'll wind up having to deal with a gain or loss. With gains, we expect that the cash coming in from the sale of that asset is greater than the book value. And the loss situation would be just the reverse, if you have less cash coming in than the book value. Gains are revenues and will increase our profits and revenues, and losses are a type of expense, which will also then impact the income statement in a negative way. So let's take a look at just a short example of this. We'll make some sales. We've got a car, a piece of equipment, and machinery. And we're going to dispose of all three of them and look at the impact on the statements. We've sold the car, and of course here we see that the car originally cost $20,000. It has depreciation to date of $12,000, and we sold it for $9,000. So the first thing I'm going to suggest is let's figure out the book value. The book value, if you remember, is nothing more than the cost less the accumulated depreciation. That's all the book value means. We present it on a balance sheet. It's simply the third number. Main account less contra account equals net asset or book value. So if we do the calculation, which I should be able to do that in my head, book value is $8,000. Okay, if we compare the book value to what we're receiving, we can see right off the bat that we're receiving $9,000. The book value is only $8,000. So we're actually gaining. We're a little bit better off after the sale. So it's going to be a compound entry. It takes a bit to put all this together. But one thing it might help is when you look at your asset account, of course we know it has a debit balance. So to get rid of the car, I'm going to drop down a couple lines and just credit the car. In all cases, no matter what you get for it, even if you get nothing, you still have to credit the asset to get rid of it, which will eventually be posted over here. Normally don't post before we finish the entry, but let me just show you. The car account should become 0 in the process. Okay, and then we also want to get rid of the contra account. That usually has a normal credit balance, which a contra asset is just the opposite of the asset account. So to get rid of that, like a closing entry, remember the closings from the old days when we closed out revenues and expenses? It's sort of the same idea. So this time I've got to do the opposite. So there's the 12, and just to, again, to prove it to ourselves, when you post it, now this account is 0, and that's the purpose. The cash comes in. Cash is going to go up. So cash is increased by $9,000, so that's an asset. And if we look at this, of course, we don't balance. If you look at the debit side, you've got, what, $12,000 on the debit side plus 9. So that's $21,000. On the credit side, we've got 20. So in order to balance this, we can see right off the bat that I need to credit it something for $1,000. And that something has to do with the fact that you receive $1,000 more in assets than you're giving up. So that's our new account gain. I'm going to put revenue in parentheses just to remind us that it is a special type of revenue account. So let's look at the impact on the statements. This is a little more involved, so we'll use the numbers to track it. And the easy way probably for me to do this is just to say the car minus accumulated depreciation is your book value. We figured out the book value to be $8,000. So getting rid of the car means getting rid of $8,000 book value. Also getting rid of the car means receiving cash of $9,000. That's a positive. So if we net this, then we can see that we're better off by $1,000. And that's going to be the end result. But I'll show you the in-between. So assets go up by equal to that gain. And when we close the books, the gain account is a revenue, so it closes into retained earnings. So retained earnings will be higher by 1,000, which means stockholders' equity will be as well. On the income statement, you will see the gain account being listed. So we have more profit. And then cash always does its own thing, doesn't it? So here, selling a car means it should be in investing. And the cash clearly over here, no, we don't have to calculate this, it's right in front of us. Cash actually increases by 9. So with cash flow, it's not about the income statement, which in this case is the gain. It's really just about cash in or cash out. Okay, so we're better off with cash, and we do see some pluses going on in the impact on the statements. The car account is gone. We would then, of course, pick up a gain account in the process. I'm not going to track cash, but you would have the gain from that. Okay, so next event is we sold equipment. And the equipment cost us $15,000. So again, the equipment's got the historical cost. Accumulated depreciation date is 13. We're going to assume that it's fully up to date with depreciation. So the book value is simply, again, the cost, 15. Get the right number here in a minute. Less the accumulated depreciation of 13. So it's been depreciated for a long time. And your book value then should be $2,000, right? But once again, when you make the sale, often this is a commonly missed entry on the final exam. It is a compound entry, and you have to remember you don't just use the book value in your journal entry. You've got to get rid of historical costs. Got to get rid of depreciation to date. So once again, I'm going to start with my credits, which is what I don't normally do. But equipment has got to come off the books for $15,000. So over here, we credit the asset to get rid of it. And now your asset account is in fact 0. You also need to get rid of accumulated depreciation, which has a credit balance. So to do so, I'm going to debit that account, just like we did before with the car. And that's going to be debited for 13. So that's going to make that go away. Okay, and then we're sort of on our own over here. We received $500 cash. So our assets are going up by $500. Okay, and we don't balance, of course, which could be an error on my part, but I think in this case it's also having to do with what you give up is not equal to what you're receiving. So if you look at the debit side this time, we have $13,005. Credit side, we have 15. So that's $1,500 difference. And if we look at the book value, we can see what? The book value is $2,000, and we're receiving something that's on the books for $500. So we're giving up an asset of $2,000, receiving an asset of $500. So this time we're worse off. And you can see we need it on the debit side to make this balance. So you can make a gain or loss a plug figure if you want, or you can sort of verify it by saying book value, if I can type, maybe I should leave well enough alone. Book value of $2,000 minus $500 cash received equals $1,500 loss. So we're worse off by $1,500. The loss is a type of expense. So I'll again remind us of that. So guess what's going to happen over here? The book value of the assets are going down by $2,000. Assets are going up by $500 because cash is coming in. We're getting rid of the book value of the equipment. As you can see, the difference, as we know, is a $1,500 decrease. So our assets are going to go down by, no surprise, equal to the loss. The loss will be closed into retained earnings, which will cause stockholders' equity to go down by $1,500. Net income will be impacted by the loss, which is a type of expense. And on the income statement, the gain or loss often shows up under other revenues and expenses for the multiple step format, which is at the very bottom. And then for cash flow, once again, cash is cash. So even if we have a loss, we're still getting a little bit of cash. So on the cash flow statement, they're always unique. We actually see an increase in cash of $500. So it's not really the same pattern as the income statement and balance sheet pattern. So gains cause everything to go up. The balance sheet and the income statement is affected positively. Losses cause the income statement and balance sheet accounts to drop. But as long as you get $1 cash in, cash flow will still be a positive flow. Okay, so we got rid of the equipment with a loss. And then the last example, we dispose of the machinery in the middle of the year. And we usually depreciate once a year at the end of the calendar year because we do statements once a year. So here we have something to deal with, and I didn't do the method calculations, but we have $3,000 and $1,500, I guess, as our cost and accumulated depreciation to date. But if we use whichever method we have, for the first 6 months, we would actually need to depreciate $500. So we're going to do a two-stepper here. We're going to depreciate first, because we can't wait to the end of the year. We need to update accumulated depreciation. So here's the $500 for the depreciation. And we've done the impacts with this before, but you have less assets when you depreciate. Retained earnings goes down because of expenses. Depreciation expense reduces profit. So that would be the impact for that. And I would need to update over here my machinery. My account now is going to be equal to $2,000. So we want to be very sure that we have depreciation fully recorded through the time that you've used it up until the sale or disposal. Now this one just says you take it to the dump. So apparently it's not the world's greatest machinery and we're just going to get rid of it. So let me go ahead here and record the disposal. So as always, the machinery account is going to be decreased, right? Machinery is an asset. To decrease an asset, it has a normal debit balance, so we need to credit it to get rid of it. And to get rid of the contra account, has a credit balance, so I'm going to have to do the opposite and debit that. And I should be putting dash machinery, but there's not much space, so I'll just do that. Okay, so accumulated depreciation is $2,000. So when I post that, machinery goes away, hopefully, got on the right side. Now we have 0. And if we debit the accumulated by 2,000, we now have 0 there as well. Okay, so that's gone. And because we didn't receive anything, which is not good news for us, the book value should be your cost, which was $3,000, less your accumulated depreciation of, I guess after we did the entry, $2,000. So your book value equals $1,000. Okay, so basically you're losing anything for that. So $1,000 comes off the books and there's nothing coming in. So the entire book value represents a loss. And you can see on this we need to debit something to make this entry balance, and that something is a loss account. I left more space than I needed to, but that's okay. So there's no cash coming in if you just simply take it to the dump, and that's it. So hopefully we get parts or something out of it. So I didn't really finish that part, but we had a loss from the first one, and you may simply lump the losses together. And this one also is a loss. We didn't receive anything for the asset, so the entire book value becomes a loss. So that this has the same impact as the January 2nd. The loss reduces the asset side of it. The loss reduces retained earnings and stockholders' equity. The loss reduces profit. And this time there is no cash. This is one of the few times where there's no cash flow from a disposal. So that concludes our disposal example.